got her first credit card and is excited about all the points and rewards she can earn. The card even gave her $200 as a welcome bonus just for signing up. Sarah thinks this is amazing. The credit card company is basically giving her free money. But wait, if credit card companies are giving away all these rewards and bonuses, how do they make money? Don't businesses need to make profit to survive? You might think credit card companies make most of their money from those high interest rates they charge. Or maybe you believe it's all from those annual fees some cards require. Well, the reality is much more interesting and sometimes sneakier than you might expect. In this video, we'll uncover the clever ways credit card companies really make their money. And trust me, by the end of this video, you'll understand why American Express made $52 billion in revenue in 2024 and why Visa's market value is over $500 billion, more than most banks. Let's dive in. Section 1. The basics. How do credit cards work? Before we understand how credit cards make money, let's quickly break down how credit cards actually work. Imagine you're buying a $100 pair of shoes at the mall. When you swipe your credit card, you're not actually paying with your money. You're borrowing money from the credit card company to pay the store. The credit card company pays the store right away, and you promise to pay back the credit card company later. But here's where it gets interesting. The store doesn't actually get the full $100. Let's say you used a Visa card. The store might only get $97 because Visa and the bank take a small cut of every transaction. This cut is called an interchange fee, and it's one of the major ways credit card companies make money. But we'll talk more about that later. Now, when your monthly statement comes, you have two choices. You can either pay the full $100 you spent, called carrying in full, or you can pay just a small portion, called carrying a balance. If you pay in full, you won't owe any extra money. But if you only pay a portion, you'll start owing interest on the remaining balance. Section 2. The first moneymaker, interchange fees. Remember those $100 shoes? Let's dive deeper into how that transaction makes money for credit card companies. Every time you swipe your card, the credit card company takes a small percentage of the sale, usually between 1% to 3.5%. This might not sound like much, but it adds up fast. Let's look at Walmart as an example. In 2024, Walmart processes about $500 billion in credit card transactions. If credit card companies take just 2% on average, that's $10 billion in fees from just one retailer. And that's why some small businesses have signs saying minimum $10 for credit cards or charge extra for credit card purchases. They're trying to avoid losing money on these fees. But wait, you might ask, why do stores accept credit cards if they have to pay these fees? Well, studies show that people spend 12 to 18% more money when using credit cards compared to cash. For stores, paying the fee is worth it because customers end up buying more. Also, in today's digital world, not accepting credit cards could mean losing customers to competitors. Section 3. The second moneymaker, interest charges. Now, this is where credit card companies really make their money. Remember Sarah from earlier? Let's say she buys a new iPhone for $1,000 using her credit card. If she pays the full $1,000 when her bill comes, she won't owe any extra money. But what if she only pays the minimum payment of $25? This is where things get expensive. Most credit cards charge around 20% annual interest rate. If Sarah only makes minimum payments, it would take her over 4 years to pay off the phone, and she'd end up paying about $1,400 total, meaning she paid an extra $400 just in interest. And Sarah's not alone. According to Federal Reserve data, in 2024, Americans carry about $1 trillion in credit card debt. With an average interest rate of 20%, credit card companies are making roughly $200 billion per year just from interest charges. That's more than the GDP of many countries. Section 4. The third moneymaker, annual fees. But wait, there's more. Some credit cards, especially premium ones, charge annual fees just for having the card. For example, the American Express Platinum Card charges a $695 annual fee in 2024. You might think, who would pay that much just to have a credit card? Well, meet Tom, a business consultant who travels frequently. His Amex Platinum card gives him airport lounge access, worth about $500 a year, $200 in Uber credits, $200 in airline fee credits, and many other perks. For Tom, paying $695 for benefits worth over $1,000, $500 makes sense. American Express knows this, and they target people like Tom who will get value from these premium cards. In 2024, American Express made over $1.2 billion just from annual fees on their premium cards. And remember, these fees are pure profit. They don't depend on whether you use the card or not. Section 5. The hidden moneymakers. Now, let's talk about the sneakier ways credit cards make money. First up, late fees. If you miss your payment deadline even by 1 day, you could be charged up to $40. In 2024, credit card companies made over $12 billion just from late fees. Then there are foreign transaction fees. Planning a vacation abroad? Some cards charge 3% extra on every purchase you make outside your home country. On a $5,000 vacation, that's $150 just in fees. But perhaps the cleviest moneymaker is what's called the behavior score. Credit card companies analyze how you use your card and adjust their strategy accordingly. For example, if you always pay your full balance, they might offer you a card with higher rewards, but also a higher annual fee. If you often carry a balance, they might increase your credit limit, hoping you'll spend more and pay more interest. Section 6. The rewards game. Now you might be thinking, but what about all those rewards they give us? Let's break down how rewards actually work. When a credit card offers 2% cash back on all purchases, they're still making money. Remember those interchange fees of 2 to 3.5%? They're just sharing a portion of that with you to encourage you to use their card more. For example, Chase's Sapphire Reserve card offers amazing travel rewards and benefits, but Chase knows that for every person who maximizes their rewards, there are several others who don't use all their benefits, pay late fees, carry balances, and pay interest. Pay the $550 annual fee, but don't get full value from the card. In 2024, Chase spent $5 billion on credit card rewards, but made over $20 billion from their credit card division. The rewards are just marketing costs to attract customers who will generate more profit through other means. Section 7. The future of credit cards. As we look to the future, credit card companies are finding new ways to make money. With the rise of digital payments like Apple Pay and Google Pay, credit card companies are now charging fees to these services too. They're also using artificial intelligence to analyze spending patterns and offer targeted promotions that encourage more spending. For example, if your spending data shows you buy a coffee every morning, your credit card might offer you extra points at coffee shops. Sounds nice, right? But their AI has calculated that this will make you more likely to use their card for other purchases too. In 2025, we're seeing new trends like buy now, pay later services competing with traditional credit cards, cryptocurrency rewards cards, cards that adjust rewards based on your spending patterns, integration with social media for group payments and splitting bills. But regardless of these changes, the basic money-making model remains the same. Encourage spending, charge fees, and collect interest. So what's the takeaway from all this? Credit cards aren't inherently good or bad. They're financial tools that can either help or hurt you depending on how you use them. If you're like Sarah and always pay your full balance, use the rewards, and avoid fees, you can actually come out ahead. But if you carry balances and pay high interest, you're helping credit card companies make their billions in profits. Remember, credit card companies employ thousands of people whose job is to figure out how to make more money from cardholders. They use psychology, technology, and complex algorithms to encourage spending and maximize their profits. If you want to learn more about how to use credit cards wisely and avoid their profit traps, let me know in the comments and I can make another video about that. Thanks for watching. If you found this video helpful, please like and subscribe for more videos about money and finance.